Can high-income earners contribute to a 401k? Hi, everyone. It's me, Nicole Green, back with you with another video. I'm a tax advisor at Robert Hall & Associates, and I'm here to talk to you about 401k contributions for high-income earners. High-income earners can contribute to 401k. We're going to talk about the limits. We're going to talk about catch-up. What is a catch-up rate? Should you do it? We'll talk about Roths, traditional IRAs, the difference between those two types of IRAs. And then we'll talk about what does it all mean? How does it all affect you? What is the bottom line for contributing to your 401k and different types of retirement contributions? Before we get into this, don't forget to hit the like and subscribe button. You guys do not want to miss one of our amazing videos that come up. Okay. Can high-income earners contribute to 401ks? Absolutely. If you have earned income and you have a 401k that's offered to you by your job, or if you have your own business and want to have a solo 401k, you can contribute. You need to have earned income, and that income needs to be subject to either payroll taxes or self-employment tax for you to be able to contribute to a 401k. There's different ways to make the contribution. And so let's talk about this specifically for high-income earners that are on W-2. Your contribution limit on the employee side, as the individual, not as the company, is going to be $23,000 for 2024. 2025, it's going to be $23,500. Now, if you are over 50, there is this thing called catch-up. Catch-up means you're allowed to contribute more to your 401k. Why do they allow you to contribute more to a 401k than somebody like me that is under 50? Because they know, the government understands and knows that retirement is top of mind for people that are aging. You want to retire. You're 50. It's something that you're consistently thinking about. When can you do it? When you can do it is really determined a lot by what you have in terms of retirement, because it's very difficult, or if not impossible, to live off of Social Security, and Social Security is not guaranteed, or at least I feel that way. Anyways, and so putting money into your retirement is going to seem a little bit more valuable because this is something on top of the mind for people 50 or older. And so they're willing to do it. They're willing to make that effort. And also they've been contributing to retirement for longer, so the muscle's been developed. Contributing to retirement, I truly believe, is muscle. Savings, I truly believe, is muscle. The more you save, the easier it gets, the more regular it becomes, and it seems less of an ask. So when you're over 50, you can contribute $7,500 more than your yearly contribution. And so 2024, your yearly contribution limit, if you're under 50, is going to be $23,000. 2025, it's going to be $23,500. You could add another $750 onto that. That retirement contribution is really, really significant for you. Let's talk about Roth or traditional IRAs. Roth and traditional IRAs are also retirements that are able and open for you. 401ks, Roths, and IRAs, and traditional IRAs are all types of retirement. They have different limits about when you can pull them out, and if you can get a loan on them, and all kinds of different things. In terms of flexibility, I do want to be honest and say that 401ks might be a little bit more flexible with you, even though the distribution age, the age where you can start taking a distribution, is going to be a little bit older than a IRA. 401ks do allow for you to take a loan on them, meaning you can borrow from your 401k and you need to pay that back. And when you pay that back, you're just paying yourself back, and the interest you pay on that, you're paying it to yourself, essentially. While in IRA, you're not able to borrow from it. You can't take a loan from it. And so if you pull money out of your IRA, you need to put that back pretty immediately for you not to have that penalty or to get taxed on that income. But a 401k, you can borrow quite a bit, up to 10 grand on your 401k. So they're all do the same thing. They're just different vehicles for retirement. A traditional IRA, just like a 401k, is going to be pre-tax. That means you don't pay tax on the amount that you put into the traditional IRA or your 401k. You pay tax when you pull it out. And so if you put in $10,000 over the years and the IRA or the 401k has grown to $50,000 because it was invested well, and you're now deducting that money from it, you're going to pay tax on all of that money. You're going to pay tax on that $50,000, the $40,000 growth, and the $10,000 contribution, because you never were taxed on that income. You didn't get taxed on the contribution, and obviously you never got taxed on the growth. A Roth IRA, you pay tax on the contribution and you do not pay tax on the growth. It is a post-tax situation. So if we have that same situation where you put $10,000 in and it grows to $50,000, you will pay tax on that $10,000 that you put in at the time you earn that $10,000. And so at the time that you put it in, let's say you put $10,000 in over 10 years, you pay tax on that $1,000 each year. And that $40,000 of growth to make that $50,000, you're not going to pay tax on. And so when you're pulling that money out, you're not going to pay tax on that $40,000 growth. Really big thing to remember here is with Roth IRAs, it is important that you do note your contributions on your tax return. People think, oh, it doesn't affect my tax return, so I don't need to incorporate this into my tax return. I don't need to tell my tax advisor if I made a Roth contribution. That's actually wrong. You do need to tell your tax advisor, because specifically for Roths, your basis is really important to know. Your basis is how much you put into it. Because if you're especially if you're pulling money out early, let's say life hands you a bunch of lemons and you're dealing with things. You need to pull money out of your Roth. You can, there's going to be penalties and things like that. But if you're pulling out just your basis and it qualifies and you're within the limits, there's rules, you might be able to, you actually can avoid these penalties. And how do you avoid these penalties? You need to have an up-to-date basis with the IRS so that they know not to tax you. Otherwise, you have to go and prove, and it's a whole thing. And so it's very, very important that you're letting your tax advisor know what retirement contributions you're making. Even if you don't think it affects your taxes, it could affect your later self down the line. Now let's talk about your contribution limits for a traditional IRA or a Roth IRA is going to be $7,000. This is for 2024 and 2025. It has not increased. The Roth contribution and the traditional contribution the limit is combined. And so it's not $7,000 for a Roth and you can also contribute $7,000 to a traditional. No, it's $7,000 with them combined. Now, if you're over the age of 50, just like a 401k, you're allowed an additional amount, a catch-up amount. A catch-up is $1,000. That means your contribution limit increases by $1,000 to $8,000. Again, it doesn't combine. If you put, $3,500 into a Roth and you put $3,500 into a traditional IRA, you can't do another 1,000 into each. You can do another 500 into each, but 1,000 total, because your traditional IRA and your Roth IRA contribution limits, it's combined. It's looking at them as a whole. Now, can you qualify for an IRA? Are you eligible to put money into a traditional or into a Roth IRA? You are not eligible to put money into a Roth IRA dependent upon your total income. You're able to contribute to a Roth IRA if your income is less than $146,000 for the year and you're a single filer. If you're a married filing joint, your income limit is going to be $230,000. If you're married filing joint, $230,000 for the both of you. If you're single, it's going to be $146,000 for just you. If you make less than that, you're totally free and able to contribute to a Roth. If you want to contribute to a traditional IRA, there is no income limits, but what is limited is if you have the ability to have another retirement. And so let's say I have a 401k. Regardless if I contribute to this 401k or not, I am not able to contribute to a traditional IRA because I have the option to have the 401k. And so if you have a 401k, you should utilize the 401k, because why does the government make this weird rule? The government gives companies incentives and puts the onus on them to support their employees, because an employer that offers a 401k, there's more likelihood that if an employer has 100 employees and they offer a 401k, as opposed to an employer that doesn't offer retirement, more people are going to contribute to the 401k than people on their own contributing to a traditional IRA. And so they would much rather you use your 401k, and so you're not eligible if you have the opportunity. Now let's imagine you had a job and you quit, got fired, laid off from your job, whatever, beginning of January, and you had this job up until January 1st. Of the year. And that job gave you the option to have a 401k. You did or didn't contribute, doesn't matter. You're going to get a W-2 from that job, and that job is going to indicate that you had the option to have that 401k. So that full year, you're not going to be able to make a traditional contribution. Yeah, that's right. If you had a job and you had the option to have a 401k for 1 day of that year, you're not going to be able to make a traditional contribution. This is not the same rule for a Roth. Remember, I can have a 401k and I can have a Roth contribution. You can do that as long as your income limits are fine. If you are a high income earner, you're more than likely not going to be able to contribute to a Roth. I mean, your income's just too high, you don't meet the rules. So what do? Are Roths completely unavailable to you? No, 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 no. There's this beautiful thing called Backdoor Roth. Let me explain what that is. A Backdoor Roth is where you contribute to a traditional IRA. You're not going to get the deduction because you're usually not eligible to contribute to the traditional IRA. So on your tax return, you won't see that deduction. But then you pull that money out immediately, and I'll tell you why you need to do it immediately in a second. But you pull that money out immediately and you do conversion over into a Roth, because there are no income limits to conversions. There are contribution limits to conversions, but there are no income limits to conversion. A contribution limit is how much money you can put into it. And so if I put $7,000 into a traditional and then I converted it into a Roth, that's called a Backdoor Roth. I did amazing. It's perfect. It's great. And now I was able to get into a Roth IRA, even though I don't meet the eligibility. I'm ineligible because I make too much money for that contribution. And high income earners understand a lot about the benefits of diversification. And so you see a lot of high income earners doing this as they understand diversification is a really big thing, and they're preparing for retirement. It's top of the mind type of thing. And they also have more disposable cash. More disposable cash gives you more flexibility to do these things. I mean, more money is more money. And you might not necessarily need the tax deduction. You accept the fact of your tax. And it's just the biggest way to get deductions as a high income earner. Anyhow, and so backdoor Roths are a really great thing for people that want to diversify or people that do not qualify. Everybody has the eligibility to get into a Roth one way or the other. Okay, so can high income earners contribute to 401k? Absolutely, yes, they can. They also can contribute to traditional IRAs or Roths one way or the other. Do I recommend that high income earners do these contributions? Absolutely. It will either reduce your tax liability, because if you do a pre-tax situation, you're going to lower your income. You're going to lower your taxable income, and that's going to lower your tax liability. Or you're going to diversify and help your tax self in the future. When you're retired and you have income that's not being taxed, but you're still receiving that income, that's a wonderful thing. Everybody should love that. So yes, you can do all of these things, and I highly recommend that you understand your limits so that you can do them. If you've got more questions, we are always here free to help you. Please click the link in the description box. You can go to our website and set up a free consultation with me or one of our amazing consultants like myself, roberthalltaxes.com. That's it. I'll see you guys later.